I've taken a whole different approach to investing than most people. You know, the idea that you always have to invest your cash is not far behind. And so I've always been of the attitude that unless you really have a commitment to something, just keep your money in cash.
Welcome back to Investment Tribe, where you've subscribed because you want to learn and generate money from cryptocurrency and other digital assets. Don't forget to leave us a thumbs up and enable the notifications so you will be alerted whenever we post a new video. Also, don't skip any parts of this so that you don't miss out on important details. And if you have any questions or recommendations, please share them in the comments section below. Investing in stock market can truly be overwhelming. It just looks so complicated when you see numbers and charts. So on this video, we will break it down for you little by little so that we can understand it a bit more. First, a little bit of history. During the 17th century, the Dutch East India Company traded many kinds of products around the world, like gold, spices, ceramics, and skills. Since this was a global operation, the overall operating costs needed a massive budget. So they thought of something clever. They convinced private citizens to put money in their company, and in turn, once the profits came in, these investors would get a portion of it based on their investments, of course. Many citizens liked the idea and invested money, and so the Dutch East India Company grew its capital, that it could now sustain the grander global operations. This is, in its essence, how the stock market works. For example, your business needs more capital so that you can expand it to other cities or countries, or you need the money for personal reasons only. One thing you can do is break down the company into small pieces and try to sell it. Of course, you are still the major owner of your business, so that you will still make the final decision for the company. What you did is that you sold your company to the stock market. The more technical term for this is called Initial Public Offering, or IPO. Let's see how much money can you make with IPO as a business owner. A great example to show is Facebook and its founder, Mark Zuckerberg. Facebook went public in 2012 with 337 million shares available. Each share is priced at $38. But of course, everyone wants to be a part owner of Facebook, and Zuckerberg realized that, so he added 84 million shares to make it a total of 421 million. Within just a couple of hours, he sold all of it, making him $16 billion richer. The stock price went up to $45 on the first day, but it was just a calm before the storm, because for the next few weeks, the stock price went as low as $20, almost half of its initial price. Now, how did this happen? Well, before, stocks were primarily bought mainly for the dividends of the profit that the company gets. Each stockholder, even you and me, becomes sort of like a part owner of the company with our shares, and we have the right to its profit. Hey, I hope you're enjoying and gaining some knowledge through this video. If you are, then please don't be shy and hit that like button for me. And you can also subscribe while you're at it. Now let's get back to the video. Let's go back to January of 2017. For example, you bought 10 Facebook stocks for $1,300 and are now part owner. Facebook made $15.934 billion that time. How much of that belongs to you? Well, the total stocks of Facebook in 2017 were almost $3 billion. So if we divide the total profit of Facebook, which is $15.934 billion, to the total stocks around $3 billion, we would get that each stock should earn little over $5 each. This is known as its EPS, or earnings per share. So if you have 10 stocks, then that should earn you around $54, right? On paper, yes. But that's not the case in actuality, because you get absolutely nothing. Since the board owners of Facebook would be the one who decides what to do with profit, and in most cases, their priority is to give the money to themselves or to expand the company. Let's take a look at another example. In 2017 again, Apple paid $13 billion in dividends, or $2.5 for each stock. A little low compared to the price of each stock, which is $170, but it's better than zero. By the next year, It is not important how much the company pays as much as the stock price, since Apple stockholders experienced a 33% gain in 2018. That's way better than the market average. Apple was the first company to cross $1 trillion valuation when its stock price crossed $200. But in 2014, Apple stocks cost 3 times that at 645. So why isn't it valued at $1 trillion in 2014? The answer is a little thing called stock splits. It's like the stocks were divided even further into smaller pieces. In Apple's case, each stock was split into 7 pieces, so the price decreased as well at $92. But not all companies can be accessible to the public like Apple. Take a look at Warren Buffett's case and his company, Berkshire Hathaway. They never split their stocks. That's why it remained at 1.68 million shares compared to Apple's at 4.91 billion. Want to know the cost of one stock at Berkshire Hathaway? It is $300,000. So only serious business people and millionaires can join this exclusive club. But not to worry, because Berkshire Hathaway created Class B shares for simpletons like you and me. And you can get a piece of Berkshire Hathaway's pie for $200 only. Another company that is only accessible to the elite, especially in Japan, is SoftBank. SoftBank is a Japanese telecommunications and internet corporation headed by Masayoshi Son, with a cost of $160 per share. The company owns stakes in Yahoo Japan, Uber, and ARM Holdings. What do you think is the reason for these companies to be so exclusive? There could be a number of reasons why these companies are exclusive. One reason may be that the companies are not as well known as other large companies, like Apple and Facebook, so they may be looking for ways to increase their exposure. Another reason may be that the companies are not as accessible to the general public, and only those who have a lot of money to invest can purchase stocks. Finally, the companies may be looking for serious and committed investors who are willing to put in a lot of money into the company and are not just trying to make a quick buck. A kind of simple explanation of the stock market is this: it works under the principle of law of supply and demand. A company increases its stock value when investors see potential for growth. The supply, or in this case, the shares, will decrease as the demand gets higher and higher. This will result in an increase in its stock price. Since it is growing, other investors will see this as an opportunity, further increasing the demand. But if for some reason the company encountered a major problem, made the headlines, and reached the public, stockholders will immediately sell their stocks to cash in their profit before the value reaches rock bottom. So, a company in a stock market is in this constant balancing act between supply and demand. So the stock market can be very helpful for companies that want to gain more capital for their expansion and innovation. But once the IPO is released, they will be in the public eye, constantly monitoring their business decisions forever. That's it for now. The topic of the stock market is long and complicated, yet very interesting. So let me know in the comments section down below what topics about the stock market you want me to cover next. Well, that's all for now. As usual, this is Investment Tribe. See you again tomorrow. Keep in mind to like, share, and subscribe to the video.